you ever wondered why one day the stock market shoots up like a rocket, and the very next day it crashes like a roller coaster gone wrong? Or why the price of Bitcoin can jump thousands of dollars overnight, only to tumble just as fast? Well, it's not magic, and it's not just luck. There are real forces at play that decide whether markets rise or fall, and today, I'm breaking it down in a way that anyone can understand. So stick around, because by the end of this video, you'll not only know why these wild swings happen, but you'll also see how smart investors use this knowledge to their advantage. Let's start simple. At its core, the market is driven by one thing: supply and demand. When more people want to buy a stock or a cryptocurrency than sell it, the price goes up. When more people want to sell than buy, the price goes down. Sounds obvious, right? But here's the twist. What makes people want to buy or sell in the first place? Reason number one: news and sentiment. Think about this. If a company like Apple announces record profits, investors feel confident. They rush to buy shares, pushing the stock higher. But if there's news about layoffs, scandals, or weak earnings, fear takes over and the stock sinks. The same is true for cryptocurrency. When big companies announce they'll accept Bitcoin, the price often jumps. But when governments threaten to regulate or ban it, prices plunge. In short, good news creates optimism. Bad news spreads fear. And in the market, optimism and fear move billions of dollars every single day. Reason number two: interest rates and inflation. This one's huge, but don't worry, I'll make it simple. When central banks, like the Federal Reserve in the US, raise interest rates, borrowing money becomes more expensive. Businesses cut back, people spend less, and stocks often fall. On the other hand, when interest rates are lowered, borrowing becomes cheap. Companies expand, investors take risks, and the market usually rises. Cryptocurrency also reacts here. When inflation rises, some people see Bitcoin as a hedge, like digital gold, so demand goes up. But if interest rates climb, investors may pull money out of risky assets like crypto and back into safer options, dragging prices down. Reason number three: market psychology. This is where things get really interesting. Have you heard of FOMO, the fear of missing out? When people see others making money in the stock market, they jump in late, driving prices even higher. But when fear turns into panic, those same people sell quickly, causing prices to crash. This cycle of greed and fear is as old as markets themselves. From the dot-com bubble in the 2000s to the crypto boom and bust in 2021, human emotion has always been one of the biggest players. Now here's the key takeaway. Markets rise and fall because of a mix of news, economic conditions, and psychology. No single factor controls everything. It's the combination that makes markets unpredictable, yet full of opportunity. And here's a secret most beginners don't realize. Smart investors don't panic at every rise and fall. Instead, they study the patterns, stay patient, and use volatility to their advantage. Now, before we wrap up, let me ask you something. If you've learned even one new thing so far, take a quick second to hit that like button. It really helps more people find videos like this. And if you want to keep learning about finance, investing, and cryptocurrency in a simple, easy to understand way, make sure you subscribe so you don't miss the next video.